Okay, so another quick format. So we're going to go 20 minutes. I'll give each panelist here, let's say 30 to 60 seconds. I'll cut you off at 60. Give a brief background and also something that they can't Google about you to get them to know you a little bit better. Ready, set, go. Tom, why don't you start?
Oh, great. Sorry. My name's Tom Tunguz. I'm a partner at Redpoint. I've been there for about 8 years. I was a product manager at Google before. I write a blog at tomtunguz.com and just published a book called Winning with Data. It came out yesterday. And something that you can't Google about me is I've had 5 near-death accidents, including falling off a mountain and being hit by a car.
Wow. Whoa. Top that.
I'm Arielle Zuckerberg. I'm at Kleiner Perkins, and I focus on consumer Series A and B investments. Before that, I've also been a product manager at Google, but most recently I was a product manager at Human. I was recently acquired by Tinder. I was also angel investing, and something you can't Google about me. I've also had some car-related near-death experiences, but at the Kleiner Perkins all-hands meeting that I was introduced at, I had the option to sing, dance, or do rapid-fire questions, and I moonwalked in front of everyone.
Nice.
So something about me. So Rebecca Lynn, co-founder of Canvas Ventures. We do early stage investing. We were in Siri. My first deal was Lending Club, which is very lucky, I think. Evernote, MuleSoft are some of our deals. And I also started life in product at Procter & Gamble. So I was a chemical engineer and then started life at P&G as a product person and then out here at NextCard. And in terms of something people don't know about me, I was actually supposed to be a PhD in nuclear engineering, but here I am. And I don't know, it's random, right? But and then I also
Direct correlation. Direct.
One near-death auto accident where I flipped a Jeep. So only one, thank God. Thank God.
So if you're writing notes, it's never get in a car with anybody on this stage.
Just one. And now I ride horses a lot, so I have a little Connemara pony that has also actually put me in several near-death situations.
You got a car story too?
No, thank God I did not have a car story. My name is Dayna. I'm a partner at NEA. I also focus across multi-stages of investing. Currently, I have 4 or 5 seed investments and 4 or 5 A investments and 3 kind of in the Series B stage. My theme of investing is that I focus on the design of products, and that has led me actually into products that help the design of products in the CAD space as well as the 3D printing space over time and manufacturing technology. Something that people don't know about me, I'm a big fan of investing in boredom, founders who have gotten so bored with their past lives that they're starting something else. And maybe that came from, actually, when I was 12 years old, I started a concession stand at my brother's soccer games because I was spending every Saturday there and just totally bored.
Complete boredom. Okay, my name's Jeff Harbach. I'm an early stage investor, and I'm also the president of the Kauffman Fellows. Just by show of hands, how many Kauffman Fellows in the room? Raise your hand. Oh, decent amount. Okay, so the Kauffman Fellows is a global leadership platform for venture capitalists. And my off-balance sheet, or what you can't Google about me, I'm the proud father of 4 daughters, which basically means that the ratio of hair accessories and items with pink to square footage in my house is extremely high. Okay, so here we go. Rapid fire question first. 2 words, starting here. Bear market or bull market over the next 12 months? 2 words.
I guess I'd have to say bear market.
Bear market.
Bear market.
Bear market.
Bull.
Nice. Way to not be consensus. Okay.
Be contrarian.
So, or be contrarian. Okay, so then Rebecca, given this kind of climate that we're in here, and that we have 3 bear, 1 bull answers on the panel, what's your investment pace looking like? Are you picking up the pace? Are you pulling back? What does that look like for you?
So I'm a contrarian investor completely. I actually think I've done a good deal if afterwards somebody laughed at me for doing it at that point in time. And so I've been really slow, incredibly slow over the past year and a half, I would say. But I actually did Lending Club in Q1 of '09. So if you remember what that looked like, it was a pretty crazy market at that point in time. So for me, in going into this market, I think it's a time, if it is a bear market, it's a time when fewer people are going to, everyone's not going to be an entrepreneur. Only the faint of heart will go away, right? Only the people who are really really in it to win it are going to stick around. And so for me, that's a great time to pick up the pace and to invest.
And over the next 12 months, same?
Yeah, over the next 12 months, I've really re-engaged lately, and I think valuations are starting to come down to rational levels. It's been harder to name 6 other companies doing exactly the same thing as the company sitting in front of you as of late. And so it's really, I think things are becoming much more rational.
Okay, awesome. Arielle, so you've been an investor for a while, but you're just recently an institutional investor with that small firm, Kleiner Perkins? Yeah, Kleiner Perkins. Tell us what you think about, kind of entering in an institutional role with these current market dynamics. What are you seeing from your seat as kind of a new perspective, fresh investor?
Yeah, I think it's really interesting to kind of start your career at a time when there seems to be a bear market. Discipline is definitely a focus, and I think the benefit is that the companies I invest in will, ride an up wave versus people who started 3-4 years ago, and a lot of their investments might be getting marked down now. So I think that's a benefit.
And do you think that your perspective there coming in new, is that helping to kind of frame the way that you're looking at the next 12 months for Kleiner and for the partners there?
Yeah, I mean, hopefully.
All right. Dayna, so let's see. Given, similar question to you, are you changing your investment strategy now, given, again, you're also in the bear camp here, given that you think that this is, over the next 12 months, what is your investment strategy looking like?
No, I hate answering questions predictably. I really wanted to say bull just to be contrarian. But I actually do agree with Rebecca that bear markets are a good time for investors, especially early stage investors. I know on the last panel, seed is the Series A and A is the B, and I don't know where it all fits anymore. But regardless, we're all early stage investors, and 2009, in retrospect, was a wonderful time to start a company, much less to invest in the company. And I think bear markets are great times for investors. It's a great time to really focus on, finding those companies that can be category killers, category leaders, market makers. It's a time for patient capital, which is a refreshing time because we've all been trained over the past 3 years that revenue is easy to get. And so if you see a company that isn't, killing it on revenue, entering this phase of hyper growth with great unit economics, it's been easy to turn them down. And now we really have to go back to figuring out what makes a good, solid company, what makes a good management team, what does it take to really file IP in some cases if you're building a technologically differentiated company. And so I welcome bear markets for investing. So I'll stick to sort of our strategy, my strategy of focusing a large part of what I do in those technology-driven companies. And in my experience, even this year, it hasn't been hard for the companies I've invested in to raise follow-on capital.
Awesome. So Tom,
Yep.
Let's see. So given what you've heard and then taking into consideration your own perspective, what do you think, what are some of the KPIs that you're looking at? What are some of the things that are making sense or that you're really watching in terms of looking at follow-on rounds, A rounds, B rounds, your investments?
Yeah, so in the ecosystem, we're kind of in an interesting place. The seed market's basically fallen by 50% in the total amount of rounds being done, but the average round size increased by about 40. But to put it in a kind of historical perspective, we're still at 5x 2010 levels. So if you look at seed A and B, we're at like 3 to 5x the amount of capital being invested in startups as historical norms. So we're in a really great time for startups to be founding companies. The interesting thing, I ran an analysis this morning, the rates of company formation have actually slowed starting in 2014. So if you look at the number of startups, according to Crunchbase, there are about 1,500 to 1,600 companies founded per year, but that's fallen by about 15 to 20% starting in 2014. And I think what that really kind of all boils down to is, as the previous panelists have said, it's a really wonderful time to be investing in companies, which is why I classified it a bull market. From our point of view, we should be deploying as much capital as possible in really great companies because the opportunities in front of us are really big. And if we kind of boil down the metrics question to an individual company question, if I had to blindfoldedly invest in a company using only one metric, be it consumer with a business model and software, it would be payback period. How long it takes me to recoup the gross margin dollars of a paid customer acquisition. That'd be the single metric I'd use.
Awesome. Just curious, any of the other three panelists, do you have any reactions to what you just heard Tom share in terms of the KPI, or more importantly, his perspective on bull market?
I do think the number of company formations has slowed dramatically. I mean, we've seen that. That's largely, if you think about why venture investors have slowed their pace, it's hard to say, oh, you know, companies aren't getting funded because venture investors aren't funding them. Some aren't funding them because companies aren't being created. So we've definitely seen that, and I think that makes it easier. I think slowing down markets, you know, whether you call it a bull market for that reason that it makes you more bullish to invest, or because it's a bull market because companies are getting, you know, marked up quickly, it's just a great time to slow down and like really think about, as a founder, what it is that is a truly differentiated product to be built. I don't agree with the, I guess if you're doing consumer, everyone's definitely focused on gross margin. E-commerce means something different these days than it did back in the retail days of flash sales and all of that. But if there's something I'm especially excited about, is actually finding companies that are building real differentiated technology that might not even be collecting their first dollar of revenue for 2 more years.
Yeah, and the only thing to add to that is I've been doing this for like 9 years now, and I was at a startup before that, and had a couple startups actually, and we've seen a couple cycles, right? And I think what people forget all the time is, as much as we live out here, is how markets just cycle, right? And so to Arielle's point, it's great to come in at the bottom. I came into venture in 2008. There was never, about a month after Lehman crashed, which I didn't think there was ever a better time to get in, and I hopefully was right. It was a great time, and we had a lot of opportunity to see great things. But for an entrepreneur, I'm always shocked that, you know, I thought at that point in time, I went to, you know, Stanford and Berkeley and talked to the entrepreneurs there, and everyone wanted to get like the one last offer at Microsoft or Google at that point. And I was just shocked. I'm like, wow, your baton is low, right? You should just, you should start a company now. And it's very and my instinct was, okay, when there's blood on the street, that's the time to start a company because you can hire, there's not a lot of competition for money. And so if this is a bear market, I think just speaking to the entrepreneurs out there, there's no better time to go out because there are not going to be 5 other people funded just like you. It's not going to look like that. It's probably the best possible time you could go out and raise money and start a company.
So how are you thinking about profitability, though? With companies that are starting, that there's this focus on getting profitable, how do you think, and this could be to any of you, how are you viewing profitability in terms of being able to raise the next round, their A round, their B round? Does the company have to be profitable? Can it still be, you know, what stage do they need to be in?
I mean, in late stage, we're seeing profitability be valued. We were talking to bankers yesterday. Profitability is up there with value all of a sudden, right? So profitability and profitability and growth, like both matter. It used to be growth at all costs. Now it's profitability and growth, and then you're fine. We were early investors. We do A and B, right? So a lot of times, I mean, I ran one of the largest online acquisition efforts, you know, for a number of years, and then I also had the P&G experience. So a lot of times people come in, and their CAC might be out of whack. They might not have quite figured it out, but they've got a great product or technology, and I look at it, I'm like, well, we can help them, right? We know how to get their customer acquisition costs down, how to hit some other channels, and really how to blow it out. So I don't look so much at the profitability, but the dogs are eating the dog food, and then I know where the levers are that we could still pull.
So Arielle, when we talk about traction, when we talk about, you know, limiting risk as things get maybe more risky in the market, how are you viewing risk in terms of your Series A investments, Series B investments at Kleiner Perkins and in your role?
Yeah, I think to piggyback off of what you said, I think if they don't have to be profitable at the Series A or B, obviously, or like, I mean, you have to believe the picture that they're painting towards profitability. As long as, you know, we kind of look at it as 3 types of risks. There's like execution risk, product market fit risk, and market size risk. And understanding which of those risks you're taking and which will affect, you know, that picture to whether or not something can become profitable is kind of the way we're thinking about it.
So Tom, some say that flat is the new round. What say you?
Oh, that's such a funny question. I think
a funny guy.
The biggest compression that we've seen just in doing the analysis of the market is at the Series B in valuations. And so we're starting to see a lot of, not a lot, but a handful of Series B rounds that are flat to the A. And so that's definitely a trend, and that's just because the Series A's were priced. I mean, I'll give you a sense. So I also joined the venture business in '08. I joined like in May of '08, so a couple months before Lehman crashed. And like when we were looking at companies, the median Series A was like 3 on 9, you know, like 4 on 12 max. Like, and then I remember one of my partners brought in a Series B that was 8 on 32 pre, and like he was almost laughed out of the partner meeting. He's like, his prices are just insane, right? And then like fast forward, 5 years later, it's like the Series Bs in the SaaS world, they start with a 1 because it's 100 pre, 120 pre, 150 pre, raising 25 to 30. And so there's definitely been a really big change. And I think what's really happened in the ecosystem is, and we just ran this analysis, like when Salesforce buys Salesforce buys demandware, they buy it on the same multiples and the same metrics that they're being evaluated in the public market, and that's free cash flow and growth rate, exactly what Rebecca said. And so that's now kind of percolating through the ecosystem, and it kind of starts at the Series B. It doesn't really start at the Series A. So at the Series A, there's definitely been some price compression at the Series A, but not nearly to the extent the Series B, where I think we would probably estimate like 40 to 50% price compression at the Series B.
I mean, I would say to the audience, to the entrepreneurs out there, for those, I was in venture in basically beginning of 2007, so I would actually say that the way the world kind of exists now in startups kind of started in 2008, 2009, that that time we were all kind of recovering from the dot-com days still and not knowing exactly what the world was all about. So, but the companies that made it through 2009 and that crash, and there were quite a few that did, and there was a large number of companies that were created in 2009, and that's been a great vintage. But the ones that actually made it through, there were a lot that were wiped out because they couldn't raise money in that downtime. But the ones that made it through would not tell you it was easy, and would not tell you they found the perfect investor every time. They obviously didn't get an up round every time, but they made it through, and they went on and went public. And Demandware is one of them. Yeah, Demandware was started. My last firm was an investor in them. Started in 2002, like after the bubble crashed, and they were one that made it through. And they definitely had difficult times along the way. Every company that's been successful, that would eventually go public, and those are the ones that we're really talking about here, not the ones that get B rounds that are marked up to 100, 200 million pre. It's the ones that are real standalone companies one day. All of them will tell you they had a difficult financing at some point, if not multiple points in their lives.
So Dayna, following your same line of reasoning here to the message to the entrepreneurs, as you're thinking about, as an entrepreneur is looking at a potential down round, what would your message be to them in terms of stick with it? What would you tell somebody that's looking at a potential down round?
I would try to encourage entrepreneurs to figure out how to, maybe not raise your next round right now if you feel like that's what you're facing. I don't think this is a market, by the way. I don't think this is a market of down rounds everywhere. I think there's just, a contraction of supply and demand right now, and sometimes prices stay the same in those cases. So I don't think it necessarily means you have to have a down round. If you are one of those companies where your valuation got out of whack in the past, then maybe you should evaluate that. But it's all about the fundamentals of the business and what you're doing, and hopefully you have strong fundamentals, and if not, you can work to get there, and in which case you might be able to push out your fundraising or something.
I mean, I think the one thing that's changed is now everybody realizes priority one for a startup is survival, right? Like, you just have to keep going, and if you keep going, then you can become a multi-billion-dollar company. But that's a skill that like either has been forgotten or hasn't been prized in the last couple of years because of the record amounts of venture fundraising and investment.
So very last question, because I think we're going to get the flash here. In terms of, 500 Startups is all about global imprint and global impact and global investing. I'm curious from your perspectives, maybe Tom, I know you guys have a partnership with eVentures in Brazil. I'm not sure if there's other international investing experience on the panel. How are you viewing the global perspective in terms of opportunities for investing, especially, again, in this A and B round space?
Yeah, so Redpoint started a joint venture with eVentures in Brazil. We have a team and a fund down there. It's a $100 million US-denominated fund. And initially it was started as a seed stage fund. And the reality about, or what I understand about most non-US markets is that there tends to be a lot of early stage capital, and then there tends to be a lot of growth stage capital, but there's not a lot of capital in the middle. There's not a lot of Series B capital. And that's definitely the case in Brazil, and it's been exacerbated there by some political and economic challenges that the country has had. And so I think the strategy that we're starting to see more broadly is funds like the Redpoint Ventures Fund. They're going to invest in fewer companies, concentrate dollars, and then reserve the dollars to make sure that the companies they invest in do succeed. Because there is a tremendous amount of opportunity there, and we're really excited by our Brazilian portfolio. But it's really just about leaping that Series B fundraising chasm. That's the big challenge.
It's funny
Really
that
quick.
that Series B issue I think is global, and it's also now it's all here. It's like in the Midwest and stuff. It's the same
Yeah, that's
issue,
right.
right? It's like A and B, A-ish and seed, and then late stage. So in terms of international, we don't invest internationally, but I found that we absolutely have to know what's going on. If there's interesting companies in Europe, for example, you need to know who those people are because they could come over here really quickly. And so, so we do definitely pay attention. We talk to them. There have been situations where we've considered it, and for the right company, we do it. But I think as an investor, you have to know in a vertical like what's going on in Europe because they could be very interesting and they could be your competitor tomorrow.
I have
You
one
have 10
final
seconds until
idea.
or
We've
fire.
been renaming stages. Series C used to be Series A. Why don't we just get rid of the Series B? Call it something else.
Nice.
That's such a marketing thing.
Please join me in thanking Dayna, Rebecca, Arielle, and Tom.
Extension.